the opportunities and risk metrics typically used when analyzing Kilde's type of transactions?
Created a scorecard where we can relate our rating to the Fitch rating. Main criteria is the size of the firm we are lending to.
Hi Radek, what are the opportunities for Kilde's private credit transactions in today's environment?
So today's environment is characterized by a lot of volatility, especially in the public markets. Like we are awaiting a lowering of interest rate by the Fed, which should boost fixed set financial instruments like high yield bonds. So they should give a little bit price boost by this. All fixed rate bonds should get a boost. At the same time, those private credit instruments which are linked to an interest rate, to the base rates, and majority of it they will start paying lesser coupons to investors. So coming back to opportunity like Kilde, we offer a fixed rate financial instrument, but because it's a private market instrument, and it's redeemable at the face value. So face value is the amount you invested exactly on the quarterly and semi-annual cycles. So every 3 months or every 6 months. This way you can have a fixed high yield despite lowering interest rates on the markets. And at the same time, you are not experiencing the volatility. On the downside, okay, the face value will not appreciate, but on the other hand, it's also not going to go down. So you have this predictability of the cash coming from your investment, and that's something a lot of investors are looking for.
And if we move over to the risk side, what are the key risk metrics typically used when analyzing Kilde's type of transactions?
So the main risk metrics we are using is the so-called risk rating. So our risk rating is linked to the Fitch and BFI credit rating. So not that we would be rating according to the Fitch, but we have created a scorecard where we can relate our rating to the Fitch rating. And the advantage of doing that is that the Fitch rating has a publicly available default data set, which is telling us what is the probability some of the investments will go bad based on the rating. And the rule is the higher the rating, the probability of some problems with the repayments is lesser. So that gives us the rating. How do we actually create a rating? So we have several criteria which we use. There's too many of them to mention them here in this podcast. But the main criteria is the size of the firm we are lending to. It plays a large role. That the share of equity into the overall assets of the company, debt servicing cost, and the net profits and the cash flow that the company is able to generate. Let me talk a little bit more about the first one, the size of the company, because it's a bit counterintuitive. In general, the larger the firm, like the more stable it is, and there are intrinsic reasons for that, because the larger firm have more professional management, they are typically longer in the market, they have more established relationships with their customers and suppliers, and as well have more independent sources of cash flow, and therefore it's generally more stable. And that's why we prefer to deal with the larger firms. And we offer them usually a lower cost of financing.
And if you do want to deep dive a little bit into our credit risk and rating methodology, there is an episode we did a week ago with Gustavo Leal. So we will maybe attach the link to this one as well in this episode. Thank you very much.
Thank you very much.